I'm excited to welcome Tom Anderson to our Chicago office today. He's an author, a businessman, and really looking forward to chatting with you. Welcome, Tom.
Thanks, Chris. It's great to be here. Really appreciate the invite.
Yeah. So you've done a lot in your career. Most recently, you're an author, and you talk a lot about the value of debt. But can you tell us a little bit about your background?
Yeah, so born and raised in Cedar Rapids, Iowa. I went to Washington University in St. Louis, worked in investment banking for about 3 years, and then I partnered with my mother as a financial advisor. We were together for 17 years, and then I left to create a financial technology company.
Wow, that's amazing. So you spent some time in our shoes. Many of our advisors are someone like yourself. So they've been around the country. They've worked with clients. And now you're working with advisors, helping them with the value of debt, which is really interesting. So how do you kind of get into that passion?
So how I got into it was actually a client. When I was at A.G. Edwards initially when I partnered with my mother, and a client brought a flyer into me that Merrill Lynch had mailed out about a mortgage. And they said, "What do you think about this?" And I said, "Well, it looks too good to be true," because the rate was just very compelling in the terms. And they're like, "Well, I don't think Merrill Lynch is making up this product." And so Merrill Lynch later called me to recruit me. And I said, "Well, I really want to learn about your lending solutions." And that was kind of a curveball. This is back in 2002. And here I am in Iowa wanting to know about lending. But the more I discovered about what they could deliver as a solution, the more I was like, that's the story that I want to tell. I want to be a personal CFO. I want to manage both sides of the balance sheet. So we moved from A.G. Edwards to Merrill Lynch and started adopting lending as a part of my practice early. And that's kind of where it all started, I guess, basically.
That's amazing. You hear a lot about the portfolios, diversification, and advisors lead with those models.
Right. My asset allocation model is better than yours.
Exactly.
I think it's a very difficult story to tell.
Yeah. And a lot of wealth is with business owners.
Yes.
A lot of those business owners have needs in the credit space. And so the way that you look at your clients, and I read through your book, is that you look at your clients and you're the personal CFO and look at the entire balance sheet. I found that to be very unique.
Yeah, well, I mean, if you think about the role of a CFO in a publicly traded company, they actually spend more time designing the debt side of the balance sheet, right? How much debt should the company have? How should it be structured? What access to lines of credit do they have? How are you running offense and defense across your balance sheet? It's actually the decisions you make with debt will have a bigger determining impact on your long-term net worth than a lot of those standardized asset allocation conversations. So I think that's where we can add value as an industry, is focusing on the liability side.
That's impressive. So there's some connotations around debt. Debt could be good, could be bad.
Yes.
Just walk us through, the different phases of someone's life where debt could make sense, and how would you leverage that?
Yeah. So first of all, it's essential to know that we're not talking about things like credit card debt. So any debt that has a cost generally greater than 10%. So all, personal loans, credit cards, everything in that space, like, get rid of as fast as you absolutely can. On the other end of the spectrum, let's say that you have a mortgage, or maybe even you got a mortgage a few years ago and the rate's at 3, 4, or 5%, then I think we could clearly say that that's going to be on the good debt category. So these things are just like cholesterol and medicine, right? There's good debt, there's bad debt. And when we're making a purchasing decision, we need to look at the macro environment around us and figure out what's the best way to acquire, whether or not it's that car, the business, the home, whatever it is that we're using, and should debt be a part of that?
I really like this conversation and kind of where you're going with it. I think it really opens up the eyes for a lot of advisors and for clients, especially where we're in this ever-changing market now where rates can go up and or down. So how do you plan for clients and advisors in a interest rate environment where they could be going down, which could be positive?
Yeah. So what happens is, a famous economist said that interest rates are neither good nor bad. They're a function of the economy at any given point in time. So the ideas within the value of debt certainly have some level of interest rate sensitivity, but at the same time, in any interest rate environment, you can actually affect potentially positive trades. So taking a bigger example, if the year was 1979 and interest rates were at 15%, but the S&P was at generational lows because from 67 to 80 it was roughly flat, it would have been genius to have had a mortgage, even though it was at a high rate, and to have built up an equity portfolio through one of the greatest bull markets ever. And of course, then rates declined exactly as you described. So you have to look at everything holistically and comprehensively to figure out where we are in the rate cycle to optimize across the balance sheet to make the best decisions.
Yeah. And I know you talked in your book about that example where someone was looking to buy a home in cash. You kind of walk through an example of where maybe you don't do it all in cash. Maybe you do some as a down payment, and then you do the rest as financing.
Yeah. So first of all, my dream would be that we all could have 100% of our money in cash. Wouldn't that be great? Like, I mean, if we didn't have to take any risk, then that would be wonderful. And so what happens is few of us can afford to put 100% of our investments in cash, nor do we want it all in cash. So we take investment risk. Yep. We can also take risk with, if you choose to pay cash for a house, you're taking risk because you have less money that's working for you over a long period of time. If you choose to have a mortgage, you're choosing to take risk, but you have to balance these two risks. I would rather have the low-cost mortgage and the liquidity of money working for me over a longer period of time. There's a higher probability of success with a lower chance of risk if you have more money. And that's what people don't understand, is how these decisions influence their quantity of money.
So how do you crack that behavioral piece of that, right? Many business owners and maybe some advisors may have had a bad experience with debt, or maybe they've been told, hey, cash is king. What are some ways that you've cracked that behavioral piece to show them the opportunities where you could leverage that in a positive way?
Sure. So this is all based on the premise that you have the money invested and you could choose to pay it off. So let's think about Apple. They have the publicly traded company. They have billions of dollars of cash. They also have billions of dollars of debt. It's not because the CFO is a stupid idiot. It's one of the most valuable companies on earth, right? So they value the liquidity, the flexibility, and the tax benefits associated with that. So how can we channel those same things? If you have a $5 or $10 million portfolio and you have $1 million mortgage, you could choose to pay that off whenever you want to, or you could choose to keep it and capture a spread over time. So it's about understanding the choices that we're making that influence our long-term outcomes.
It's absolutely amazing. So you spent time in it as an advisor, and you kind of led with this as a tool and as a technique. Can you tell us about some of your successes?
Well, yeah, they fall in a lot of different categories. So what some of the biggest successes actually end up being in things like First Bank of Mom and Dad. So sometimes I'll find that, first of all, what I find within high net worth clients is that about 50% of people like access to liquidity, but don't use it at any given point in time. So there's just part of having this conversation. A lot of people still don't adopt, but that's totally fine, and it changes the game. The other thing people do is they're trying to help out their kids. So maybe I'm trying to get a down payment for my kid's home, or start out my kid's business, or maybe I'm trying to help out a parent or who's moving into like an elder care facility and they need to sell their home. You can bridge a lot of generational things with small draw loans to kind of solve things, and those were neat successes. The business owner or investment banker who wants to own an Aston Martin, right? Instead of paying cash for it, or having an Aston Martin car loan, which is a weird thing to do, or a boat loan, those are weird things. You can facilitate really cool toys, and those are like a part of the fun stories. And then I think the neater ones are in the, what you can do in second homes, what you can do in first homes, what you can do in making dreams possible. Like you can, oftentimes debt can make the pie. A little bit of debt the right way makes the pie bigger. It makes your dreams possible.
It's awesome. And I think with business owners, many are dealing with net 30s, net 60s, net 95s, or wherever they may be, where they may not get paid for a certain period of time, and having that access is huge. You think about real estate, the speed to close is essential, especially if you're in a hot market.
Absolutely. It's about, so business owners value the liquidity and the flexibility. When you are in, if you're an attorney or you're an investment banker, you have these lower bases and bonuses. Even doctors have kind of quarterly bonus cycles and year-end distributions. Everybody values flexibility. And so using the right debt as a strategy, especially things like a wealth management line of credit, is incredibly beneficial just to bridge that liquidity gap that we all face from time to time. So yeah, that's exactly right. Everybody benefits from it.
Awesome. And I know there's a lot of different structures when it comes to debt, but can you give us kind of like a high level, like a 1, 2, 3, kind of some examples of what are some different ways that you see high net worth clients use?
Yeah. So Two things, and without doing a commercial for you, you guys are extremely competitive in your mortgage business right now. So a lot of people don't think of Raymond James as having a bank. You're one of the largest banks in the country. So mortgages are a clear and obvious thing. But I want people to de-emphasize paying down their mortgage. First, build up your portfolio. That is kind of playbook number one. So I'd rather have more money in my portfolio and then pay down my debt later. That's the first playbook. The second part of the playbook is a wealth management line of credit. So it costs nothing to set up. There's no ongoing fee to have it. And then it's just standby liquidity where you're only paying interest on the amount that you're borrowing at any given point in time. You can actually let that interest cap and roll, which gets a little bit technical. But the line of credit creates incredible flexibility for when you're buying a boat, you don't need a boat loan. You need the best way to buy that boat, right? And this is what that lets you do.
Time and speed. Sometimes
time and speed, instant access to the capital.
Especially in real estate. And I'm sure you mentioned that earlier, like the second home.
It's one of the most common uses. So taxes, when you have like your accountant calls you up and says, hey, you have a $50,000 tax bill due, right? You can use the line of credit and then figure out how you want to do it. Buying a new car, right? You want to drive off the lot that day. You can just wire the money and do that. Or in real estate, you're exactly right. A lot of times when you see a cash buyer, more often than not, what's behind that is a wealth management line of credit. It's just someone who could step in, act quickly, and then figure out how they want to, or even if they want to have debt in their long-term picture.
Yeah, and when you talk about the real estate piece of it, it's just the speed to close. And
speed to close.
Your dream home or not getting your dream home.
Right.
And the cash may not be a cash deal. It just may be the way that they're leveraging their tools.
No mortgage contingency, no appraisal required. I mean, you can choose whether or not you want to appraise it, but from the buyer perspective, from the high net worth individual, you could just write the check right now for that property. Anything else that you're doing are things that you're choosing to do as a part of the process. They're not requirements, which makes it, how does anyone compete against that?
So you talk to a lot of advisors all across the country. You're a keynote speaker. What advice would you give someone starting out today where you were a few years ago, rocking and rolling, and they can either go out and they could discuss alternative investments, they can talk their diversified portfolio. What recommendations for them to start? And then what advice would you give someone that's been doing this for 20, 30 years?
Yeah. So to the new person, what happens is, imagine if we were in a casino when we were playing something like roulette, right? And then if we sat there and I played a $10 hand and you bet more over the whole period of time, when we walk out, if we win or lose, it will be a function of how much money we had on the table, right? We had the same odds the whole time. What happens is, to new people, what they don't understand is that the quantity of money that clients have invested is what influences outcomes over time. And the quantity of money is shaped by the decisions people make with debt. So you can't look at these as separate. They are completely integrated. And so therefore, as a new person, your competitive advantage is the more you channel this energy that no, all of your decisions will be shaped by what you choose to do with your debt, when you choose to pay it down, how you choose to pay it down. I want to be your guide to help shape those decisions. Those are powerful conversations that resonate with people. So if I was a new advisor, that is what I would focus on. I'm going to help shape your long-term decisions, and we're going to make those together, right? Like arm in arm. Yeah. To people who've been in the business for 25 years, everything you need to do to be successful, you have access to. What you need to do, so many people get in the business for 25 years and they turn off their growth engine. I don't understand why. It is easier to take $1 million business and turn it into a $2 million, a $4 million, an $8 million business. It's really hard to get that first $1 million business built. So if you've been in the business, narrow your focus, tell the personal CFO story. There are 50 to 100 families that want to know it, that are willing to pay for comprehensive holistic guidance. They don't believe in paying for asset allocation models. They don't want to pay. They want to pay for advice. And this is where advice lives. It lives on the other side of the balance sheet.
I really love that personal CFO. That's really strong. And I'm sure you've heard of the theme, become your own banker.
Yep.
Per se, where you basically can
right.
leverage the tools and kind of do that yourself. So that's really amazing. So Tom, you've written a book, you started companies. What are you doing now with the free time that you do have?
So now I own the website freefinancialplan.com, and we rank #1 in AI financial planning. So we're trying to deliver better solutions to more people is essentially what the goal is, to try to guide people how to use their balance sheet comprehensively and how to think about both sides of the picture working together to create better long-term financial outcomes.
It's really impressive. I'm really enjoying AI. I've tested it out and played with it here and there. I think it's here to stay. What are your thoughts there?
Oh, we're in the first inning of how exciting it is. So, the internet was clearly neat and transformational. Cloud computing was difficult for people to understand, but now you can get any movie, any song, any picture that you want on your cell phone, which is just absolutely crazy how much the cloud changed in our life. AI is really going to transform everything by just setting a completely different baseline for the conversations that people can have. And that's what we're trying to do, is give people tools to empower them to have better conversations with their advisors, because there's always going to be a judgment call and always a role for advice. But once you can get to a stronger baseline faster, then you can have the judgment call conversation. So that's how we view the future of AI.
I can tell you're a believer and you're pretty passionate about it.
Yeah.
So Tom, I want you to leave us with one thought. Our audience consists of financial advisors, business owners, CPAs, also attorneys and executives like yourself. So what's one thought you'd like to leave the audience today?
So the one thought that I would encourage you to think about is, if you don't presently have access to a wealth management line of credit, it's a perfect time to set one up. There's no cost to have it. There's no ongoing fee. It starts by just being emergency defense in your life as standby liquidity. And then you can work with your advisor to figure out if or when you end up wanting to use it in the future. But start thinking about how your quantity of money will shape your long-term financial outcomes and how you can use both sides of the balance sheet to make the pie bigger.
Awesome. Thanks, Tom. Well, thank you for coming in.
Absolutely, Chris.
I enjoyed reading your book and can't wait to have you sign that here in person for us. But really enjoyed your time, and thank you. And for those that are in the audience, it's The Value of Debt by Tom Anderson. Thank you.
Thank you, Chris. Appreciate it.